I'd like to introduce your moderator for today, Mike Sisk, contributing editor for American Banker. Mike, you have the floor.
Thank you very much, Caroline. And I would like to welcome the audience once again. We are very grateful that you've chosen to share some of your busy day with us. We know that your time is valuable, and we will honor that today with what I'm confident will be an enlightening 60 minutes or so of discussion. Once again, our topic today is single-family rental, capital constraints amid crisis and opportunity. What's the solution? And my name is Mike Sisk. I will be your moderator today. I'm a contributing editor at American Banker, and my articles have also appeared in Barron's, Crane's New York Business, Inc., Institutional Investor, Strategy in Business, and Worth. And as you can see, we've got a great panel here. Ben Hall, VP Product at Altisource, Michael Finch, Executive VP, Principal at SVN and SVR Hub Advisors, and Michaela Lumpkin, SVP, Head of Team Lending at CoreVest Finance. And just before we jump into the agenda and some more in-depth on the bios here, I wanted to just remind everyone that we will have time at the end for some Q&A, about 5 or 10 minutes. And you can put your question into the queue throughout the hour as it occurs to you. You don't have to wait until the end to do that. So please, get that question in the queue. We'll make every effort to get to the questions you asked today. And if for some reason we run out of time and can't get to a question you've asked, we will definitely follow up afterward. So please ask away. Your voice will be heard, and we very much want to hear from you. So we are going to have a real great discussion here on a couple of topics. Let me just run through them here briefly with everyone here so you can sort of get a sense of where we're going with our discussion today. So it'll be a brief look at the state of the SFR and fix and flip markets, the COVID-19 impact on capital and credit policies, why bringing standardization to underwriting guidelines is important, how standardization could improve CMBS securitization ratings, solutions that can reduce credit risks for private lenders, and paths forward to increase access to capital for real estate investors. And then after that, as I just mentioned, we'll have that Q&A where we'll look forward to hearing from your questions. So let me just take a moment here to give everyone a little bit more bio information on our great panelists today. So Michaela Lumpkin is Senior Vice President, Head of Term Lending at CoreVest Finance. She was responsible for managing the operations of term financing products. Prior to joining CoreVest, Michaela was a Senior Associate at Orrick, Harrington, and Sutcliffe, practicing in the real estate and finance group, where she focused on the acquisition of distressed debt, as well as both mortgage and mezzanine financing. She received her JD from Georgetown University Law Center and her BA from the University of Virginia. And we're very, very pleased to have Michaela with us here today. And joining her is Michael Finch. Michael has been an advisor and practiced at a licensed commercial real estate brokerage since 2005, and he is based in Phoenix, Arizona. Michael is considered a national leader in the single-family residential and the build-for-rent investment portfolio segment. The SFR Hub platform typically has approximately $1 billion to $2 billion pipeline of activity in the SFR BFR investment segment. Today, Michael is principal, founder, and executive vice president of several CRE client support companies, including SVN, SVR Hub Advisors, SVRHub.com, SVR Hub Modular, and a member of the general partner of SVM SFR Capital Fund. And he's a principal of FFR Capital Management. Spearheading much of the business development within the SFR Hub platform, he has the privilege of working with the best teams in the industry and continues to push the boundaries, creating continued disruption and dominance in the specialized investment class. And we're very, very happy to have Michael here with all of his expertise joining us today. And finally, rounding out our panel is Ben Hall. Ben is the Vice President of Product for Altisource, a leading service provider for the real estate and mortgage industries. He leads multiple subsidiaries for the company, including Premium Title, Trustee Services, Springhouse Valuations, Granite Construction Risk Management, and Rent Range. During his 17 years in the mortgage and real estate industries, he has held multiple leadership roles specializing in product development, centralized fulfillment, system integration, and global solutions. He firmly believes the best industry solutions can only be validated by a positive customer experience. And really very, very pleased to have Ben here with us as well. And I think what we're going to do right now is I'm just going to turn things straight over to Ben and he's going to kind of introduce our first topic today, which is a brief look at the state of the SVR and flip and fix markets. And Ben, let me kick it over to you. Please take it away.
Thanks, Mike, and a big thank you to National Mortgage News and Altisource for putting together a very timely discussion for owners, operators, investors, and private lenders that are navigating a very fluid global health crisis and its impact on the SFR and fix and flip investment markets. I'd also like to thank Corvest and SVN for allowing us to take an hour with their esteemed industry experts. I think I'm as excited as anyone to hear from Michaela and Michael today on their 2020 market learnings as well as outlooks for 2021. Before we jump into the heart of today's discussion, accessing capital, I think it's important to set the stage on what's happening at maybe a more macro level in SFR and fix and flip. So let's get started. I'll try to go through these high points as quickly as possible. What do we know? So in 2020, inventory is low and demand is at an all-time high. We've seen builders and investors that do have access to capital. They're certainly finding success in the build for rent space and lots of momentum building there. The first 6 to 8 weeks of the pandemic, it sent shockwaves through capital markets as fear of the unknown took hold. Most lenders halted originations completely or tightened guidelines considerably, and interest rates climbed. Those investors and private lenders that were well established in the space, trusted the stability of SFR market. They aligned quickly with their funding sources, and a lot of them went on the offense. They went on offense earlier than others, and they really took an opportunity to seize market. Initial reaction from many owners and operators was to offer rent concessions and waive late payments in the early months of the pandemic. That quickly has shifted to near normal operating practice, and in most cases, rent increases with increased demand. In Q3, we've seen institutional investors report strong rental collections and occupancy rates, often north of 97%. So again, I think we've all heard and starting to see, report after report, just the legitimacy of this market, and it's really at a global level now. With inventory at an all-time low, there is significant focus on acquisition strategies going into 2021. Many investors are focusing on the build for rent communities, new construction, right? If you can't find it, you build it. Others are positioning for a market grab with an anticipated spike in foreclosures. Investors are formalizing auction acquisition strategies, targeting markets where there is high percentage of seriously delinquent loans that align to their buy boxes. And most interesting here, I think, is the mom and pop and the small investors that still make up more than 90% of this SFR market. Investors are heavily focused on how to increase their market share while inventory is tight. While there are still concerns with unemployment, unknowns around eviction moratoria, and stimulus relief, smaller investors are just not as well positioned to navigate times of uncertainty. This may be a time for larger investors to execute a plan for increasing their market share on the existing inventory. So with that, Mike, what I'd love to do is maybe turn it back to you for a quick polling question as we look at opportunities and strategies going into 2021. I'll turn it back over to you.
Excellent. Thank you. Here we go. All right. So everyone, what I'm going to do, I'm just going to read through the question here and the possible answers, and that'll give you time, I'm sure, to make your selection. And then we'll share the results live here with everyone. So what SFR investment strategies are you primarily targeting going into 2021? Is it build for rent and new construction, vintage SFR acquiring existing rental assets, or distressed homes foreclosures? So everyone just given a moment to consider that. And again, this is what investment strategies are you primarily targeting going into 2021? And all right, that's probably plenty of time. So let me go ahead and share results here with everyone. And all right, so results pretty well spread across the board here, but distressed homes, 42.9%, as you said, cited that. So Ben, back to you. What do you think? This is kind of what you expected to see?
Yeah, no. So we've seen a lot of interest and a lot of publicity around build for rent. So that's certainly an emerging market. But I think what the reality is a lot of investors are still really focusing and looking at that foreclosure grab. When the market turns, when there's a correction, a market correction, this is really what where I think a lot of the institutional investors today really grew their market share was, in the 2008, 2009 crisis. There was a lot of opportunity for investors to pick up and restabilize neighborhoods. So I think there's a lot of that strategy that preparation taking place today. Continuing on here, as we look at just other things from 2020, urban flight, that is a real thing. Reports from institutional investors and consulting firms, have suggested anywhere from 1/3 to 60% of new tenants in Q3 moved away from urban locations. As a result, the suburban market rental performance has been the big winner in 2020. I'll touch briefly on the fix and flip markets. Most fix and flip investors still see a significant opportunity, I'd say, over the next 12 to 18 months with historic market demands and limited supply of new inventory. Profitability is still performing, I'd say, the strongest in the Northeast, where it's less competitive with rental investors. Before we jump into the capital discussion, Michaela or Michael, anything that you'd like to add with activity and performance in either SFR or fix and flip?
I'll jump in real quick, Michaela, and thank you, Ben. You a lot of good points there from really the beginning of COVID till now, and so much has happened. I think it's important to note what COVID has proven, right? There's been a long trend, moving towards suburbia and single family rentals and even new construction build for rent. It's been going on for some time, but I would absolutely argue that COVID has not only accelerated the pace of a lot of that, but also proven what many of us that have been in the industry for some time have been preaching, which is this is an asset class that has always weathered recessions and will continue to weather recessions, with a solid, executed business plan and strategy. Because, when there are downturns in the CRE and housing markets, the rental demand never seems to dwindle in the single family markets. And that's again being proven over and over again here. There was a new stat that came out just, I think, earlier this week or last week by John Burns that was looking at single family rental forecast compared to multifamily in 2021. And single family is on pace on average nationwide, obviously some markets greater than others and some a little bit less, but on average predicting 3.1% rent growth, where multifamily is predicted to be a negative 1.1 rent growth in 2021. But we're seeing some markets like Phoenix and Nashville and Jacksonville, that are, climbing at 6, 8, 9% rent growth. And Phoenix has been doing that year over year. And there's a number of others that are well over, the 3.5 or 4. So what better place, if you're, in an office, multifamily, retail investor to be putting your money if you're looking for stable cash flow and long-term growth. And then, the advent of the institutional capital that's coming into the space because of all these things. I think in some level it scares some of the smaller guys, but to your point on their, institutional capital still controls less than, 10%. I'd be shocked if it was even 5% of the inventory at this point. So the mom and pops still dominate, and there are still opportunities out there. Whether you're a fix and flipper, you find the right deal and take advantage of the retail highs today, or you put a tenant in there and you just hold on for long-term growth. You're going to win, from a appreciation value or a good, nice, stable return from a rental value. So, I think COVID is simply proven again the risk mitigation and stability of this asset class.
I certainly agree, Michael and Ben, with that analysis. I think what we've seen on the CoreVest side is really the urban flight. Just looking at our securitization data tapes, it's interesting to see that 11% of apartment rentals are 3 bedrooms, right? What we're looking at our tapes, we found, and 65% of SFRs are 3+ bedrooms. And this demand, right? The world is a very, very different place today than it was in March. And there is certainly such an increased demand for SFRs and the occupancy rates and collection rates, which we've been particularly on the CoreVest side, just paying such close attention to, have been surprising. It was certainly not something that we expected to see, and it's really nice to see the product and this asset class legitimized as a result of folks needing and wanting more space.
Yeah, I mean, we were seeing some data recently, just on renewals. Operators have been able to push rents, somewhere between 2 to 5%, and the ones that aren't afraid to lose a tenant, are hitting, lease rate jumps between, 6 to 10% sometimes, which is incredible. But that just gets back to the, the lack of supply and of homes on the market, both for sale and for rent. And obviously the downshift of, some of the bigger cities. I read something yesterday, 35% of their rents are down 35% in San Francisco, apartments, because they're all moving out, But the operators have been at 98%, and if you're at 98% occupancy, you can push rents all day long.
Wow. Thank you all. Thank you. And let me loop Michaela back in here and turn to our next item on the agenda. So in terms of, share with us a little bit, if you would, COVID-19's impact on capital and credit policies.
Sure. It's a very pertinent question. And I think that it won't be surprising for me to say that when COVID hit, like many lenders, we pumped the brakes a little bit to see what was going to happen. It was a crazy market and something so unforeseen that we really wanted to make sure that we understood any ramifications that were going to impact our sponsors and borrowers, and come up with an idea on how to refresh our underwriting policies to make sure that we were aligning correctly. What we spent a lot of time doing in those early days was speaking to and interacting with our sponsor teams throughout the country. And we found that although some tenants were delaying payments and portfolio collections were strong, and there was still a lot of demand for the term product, which I think was surprising because we were being pushed to continue to fund loans as we were very quickly trying to assess how, in fact, we were going to mitigate, the additional risk and the uncertainty, right? Early on, the revisions that we made to our credit policies were what you would naturally imagine, right? We tried to, we did, in fact, increase our FICO score limitations. We scaled back our LTV. Typically, our portfolios can go up to 75% LTV, but we limited that to 70%. It's since gone back to normal. So Ben alluded to the fact, right, that there were rates went up and guidelines became a lot stricter. I'm happy to announce that the guidelines have relaxed somewhat, and the rates have certainly come down, right? But there was that initial shock that traversed the industry, right, where the rates skyrocketed. These guidelines really were much more restrictive, and since then we've been able to kind of go back to normal, quote unquote, whatever that might be these days. We also have spent, and I think this is just a good best practices anyway. Our portfolios are required to be at 90% occupancy to fund. And occupancy doesn't always correlate to collection. So we spent a lot of time confirming rent rolls, rent collections, so that we understood what the sponsors were actually, what troubles they might be having, right? And we've been pleasantly surprised to see that those collections month over month, right? And there was a lot of talk about how when the stimulus funds ran out, we were going to see kind of a spike in the ability in vacancies, in collection rates, or credit loss, and we haven't seen that quite yet. We've been kind of waiting, and fortunately, rent collections have been very much in line with where prior months have been for the sponsors that we're working with. We also decided to really stick to our core asset class. Over the years, this is a product, the portfolio rental program is one that we developed at CoreVest in mid-2014. I came on board in 2016, so I've been through, 13 plus securitizations at this point at CoreVest. And we've been seeing an uptick in the multifamily properties that we've been financing. Our core asset class is SFR. We do townhomes, condos, small multifamilies, up to 4 units, or, what is traditionally known as an SFR, 5, 6, 7 garden style units. And we kind of scaled back from doing the larger multifamily when amidst, the portfolios that we're renting. Because one of, I think, the nicer things about our product, and one of the things that sponsors tend to like more, is that we are perfectly happy to put in, a 50 unit multifamily with 76 SFRs, 40 duplexes, so on and so forth. But we did kind of at the beginning, April, May, go back to that core asset class that we were looking at. And then the last thing that we did was we implemented, like many of the GSEs did, in a less onerous way, holdback reserves, right? Reserves that sponsors could access in order to cover any rent shortfalls that could occur. So those are really kind of the core credit policy shifts that were made. Thankfully, a lot of those have relaxed. The demand has continued to skyrocket. Every month has been a larger pipeline than the last. So the demand has been incredibly strong, and we've continued to lend throughout the crisis, and we've continued to securitize. We are in the midst of a securitization right now. This will be our 4th one in the year. We went out in actually April with a securitization in a very turbulent market, and it's important to note that the execution was good. I mean, it wasn't as good as this current one, but it was a very strong performance, and we were the first issuer out in April. And it was, I think, as a result of being an issuer for 5+ years and folks looking for yield. Since then we've had multiple securitizations. They've all been heavily subscribed. This last one was at the tightest levels in the history of our shelf. So I think it just speaks volumes for the asset class. If there is any sort of silver lining to COVID, I think that for the SFR market, it has really continued to legitimize the asset class, and we're just in a better position today than we ever have been.
Interesting.
And Michaela, to follow that up, one of the things that we've been hearing at various conferences is the lenders are quickly getting back to pre-COVID guidelines and or rates. But then when we talk to some of the investors, maybe that's not always the case, right? That not every lender is operating the same way. Has CoreVest seen any shift there or any new opportunity with, maybe lenders not going back to pre-COVID rates?
Well, before I answer that question, Ben, I think it's a really good intro to a poll question I have that if Mike could introduce, that would be great.
Yeah.
I would be happy to do that. So here we go. Let's get this one up here. And this is a real quick yes or no question, folks. Investors, have you had issues accessing long-term debt for your investment portfolio since COVID began? And this is a quick yes or no question. Give everyone a moment or two here. This is when I wish I had my Jeopardy music. Again, investors, have you had issues accessing long-term debt for your investment portfolio since COVID began? And I bet that everyone could answer that one pretty quickly. So let me go ahead and share. And there we go. 55.6 no, 44.4 says say yes. So there you go. What do you think, Michaela?
I think that they must be using CoreVest, so that makes me pretty happy.
There you go.
So Ben, sorry, reiterate your question for me so I can answer it. I was curious to hear from folks on the line, because I've heard a lot of mixed, in all seriousness, I've heard some mixed messaging on that side, right? We have folks that come to us, right, almost every day, that have been in underwriting with other lenders that, and less so today than maybe 3 or 4 months ago, that got really stalled out, right? That there was a very limited liquidity in the space and access to capital, and people were really freaked out, and they didn't know what was going to happen, whether they had certainty to close, whether they were going to be able to even refinance this year or acquire that portfolio that, they were under contract for and they had to hit that date. So I feel like while our guidelines have certainly relaxed since COVID, we are by no means back to normal, right? And we're lending at the same rate, and our portfolio is the same size. Rates are still a bit higher, even though they've, through the securitizations and the positive executions, they continue, like that's a great signal for us, and rates will go down and continue to go down. But fingers crossed if all stars align, but we are by no means back to kind of the business as usual guidelines where we were kind of in January.
Yeah, no, that helps. And that's pretty consistent with what we're hearing. I think one of the things that sometimes doesn't connect, right, is you'll hear from all these different various, lenders in the space. And, the general message is, hey, we're pretty close to, being back to pre-COVID levels. But then when you speak to the investors that are trying to secure that capital, they're just, having a difficult time with getting to the next deal because they haven't been able to secure that. So it sounds like there's sometimes maybe a different message between the lenders and the investors in the space, and maybe not all the lenders are operating in the same way because it's such a fluid environment. So it sounds like CoreVest has been pretty much a net positive throughout the pandemic, but I don't know if that's necessarily the case across the board. I
think it's important to note that we did continue to fund, right, at a very scaled back level, but it hasn't. It wasn't. It's been a gradual process of ramping back up, despite the continued funding that we'd have, and we're here and we're ready, but the guidelines have certainly, we've had to take a look at things. And one of the things I think that is certainly something that we're much more focused on is collection as opposed to occupancy, right? And not necessarily hitting folks with a credit loss that they're going to have to live with throughout the term of their loan, but really taking the time to thoughtfully consider the last couple months of collections and then making informed credit decisions based off of that.
Got it.
Excellent. Let me turn to Michael now, and if you could share with a little bit about why bringing standardization to underwriting guidelines is important.
Yeah, I mean it's critical, right? Both for investors and lenders. We've here at sfrhub.com, which is our data and valuation technology platform that powers our brokerage, SVN, SFR Hub Advisors. But we've spent a lot of time over the years cultivating, the AI that's in the background of our machine, so to speak, to make sure that we're utilizing data and cleaning and scrubbing the data that we're pulling in on the portfolios that we're analyzing, because there are so many data sources out there, and it's challenging when you're trying to look at these larger portfolios that could be scattered around multiple states and counties and cities. It's imperative for both the investors and the lenders to have good quality data, and that's what we've created in our advanced SFR scrub report, where we're checking 35 points on every single home. We pull in multiple data sources. We're red flagging discrepancies within the data. We've got human capital and boots on the ground digging into that data, to verify that, for a short example, that fourth bedroom that, was converted from a garage, actually had a permit pulled because of that. If that didn't happen, that's a 3-bedroom home, and that affects the valuation. So, really cleaning and scrubbing the data prior to running it through our valuation models to create, a fully vetted report that, provides that clean and verified data, plus valuations on the home, plus the income approach, and putting that into a spreadsheet, that, like Corvus, they look at our property tapes and our ASR scrub reports all the time when we're introducing clients to them. And it's important to create that sort of standard model to help the lenders and the investors more quickly underwrite and have trust in the information that they're looking at. Because there's so much out there that is, if you use the MLS and compare it to Zillow, I mean, you're going to be 8 to 12% off on values almost every time. So creating a standardization and reporting mechanism, for the lenders and investors is a necessity in this space in order to get those loans through and get those investors qualified and make everybody win at the end of the day. And I think that's something that we've been able to accomplish at sfrhub.com pretty successfully. And I got to tap my team and our tech and real estate valuation experts on the back for assisting in that process.
I agree with Michael wholeheartedly. Clean data is huge. I mean, it's everything. It's the cornerstone of what we need to have in order to properly underwrite the assets on the debt side. And if you don't have that, you really don't have anything. So from our perspective, standardization in our underwriting guidelines is how we control risk. Clean data is how we control risk, right? And we have to set up, we've had to set up our platform in a way where we can replicate it, right? We love to say around here, right, that it has to be burger, shakes, and fries, because if you don't have that, then you can't go to market with a securitization because you can't close volume and you can't scale. And scaling is everything in this business, right? If we had continued with a trajectory of 2 securitizations a year, we're up to 4 now, we just wouldn't have a business, right? It wouldn't be what it is today. And it's really important for us to be able to scale our business so that we can service more investors in the market with better rates, and a big part of that is securitization. Yeah,
and it's about trust in that data too, right? I mean, that's we pride ourselves on that, and that's why we work so closely with Corvus, because they've now, over the years of working with us, they've grown accustomed that we're consistent in that data and valuation product. And you gotta be able to repeat that, or else what value are you bringing to either the lenders or the investors? And I'm just couldn't be happier with our team here at sfrhub.com and what they've accomplished in bringing that consistency to our standardization of underwriting.
Excellent. Let me jump in here. I've got my eye on the clock here, and we've got so much great material to get through, and I want to have some time here for our audience members to ask some questions, and I see some good questions coming in. So let me just loop Michaela back in here. How could you talk a little about how standardization could improve CMBS securitization ratings?
Absolutely. I think I kind of alluded to it because the questions are super related, right? How standardizing underwriting guidelines is important and how standardizing underwriting guidelines improves your securitization ratings. I think that we've been delivering a standardized product to the market for the last 6 years. And how we are able to do that is by creating something that we can replicate time and time again. So that has certainly improved our securitization ratings, that the rating agencies understand the product. It's the same thing that they've seen time and time again. And they understand how what our underwriting guidelines are, any minor tweaks that we've made to it, but the core product is the same. And I think that's one of the items that's made us tremendously successful, that if you come to CoreVest, you know exactly what the process is going to look like, what your timeframes look like, the documents that we're asking for. It's the same list for every loan. We're not pulling out new requirements. So I think that that's just been really important for the rating agencies. We always require interior appraisals. It's very burgers, shakes, fries. And I don't mean to make it sound unexciting. It's hugely exciting, and every deal is very different. But we can't have this product was developed right with the CMBS market in mind, but with an asset class, SFRs, right, that hadn't been viewed from a CMBS lens. So the document, the loan documentation, the legal requirements, everything was based off of CMBS requirements because that's what the market was comfortable with. And we knew that's what the rating agencies were comfortable with, right? So we had to reverse engineer from CMBS and then kind of with SFR assets, right? And I think that the rating agencies caught on really quickly that they were positive differences, right? Instead of one multifamily property, you had 100 SFRs, right? If one asset goes down, you still have the ability to cover debt service very easily, while that one asset that might have flooded or had a fire or whatever it might be is repaired, your cash flow stays very consistent. So I think it's we've made some tweaks, certainly, and I think as time has gone on, we've kind of backed off of some of those more onerous CMBS requirements that didn't quite make a ton of sense from with an SFR asset class like cash management, for instance. We had to overlay property management in a different way, and we've done so in a way I think that was really artful and successful, so that folks that were used to seeing a CMBS product got very comfortable quickly with this SFR asset class baked into it. And the rating agency levels have only improved because it's been, like I said, very replicable, very consistent, and positive.
Great news.
Excellent. Yeah. Michael, let me ask you, could you share with us some solutions that can reduce credit risk for private lenders?
Yeah, I mean, and again, this gets into, everything that Michaela just said and what we've been working on, which is constantly improving, our process, to deliver property tapes to lenders that they can continue to trust and build upon for their needs. We're right now and we're hopefully in 60, 90, 120 days into 2021, we're going to be rolling out a product that I think is going to be very competitive in the market and useful for hopefully all lenders. It's gonna entail everything that I had described in our underwriting, and providing clean and verified and quality data and valuations. But we're working with another group right now to create a report that's going to be able to pull in the physical inspections that Michaela was talking about, needing those interior inspections and also appraisals and with what's been happening now in legislation and AVMs being able to be utilized more frequently by lenders, especially for homes under $400,000. creating a tool that can be a one-stop shop and, help, minimize the cost of, getting clean and verified data, having physical inspections, having, point or, checkpoint appraisals, so to speak, where, maybe not all 100 homes in a portfolio need to be appraised because, the valuations are, and the standardization of the underwriting is becoming so trusted and well known that maybe it's only 20% of the homes need to be spot checked on an appraisal method, but really creating a tool that we're going to be rolling out for lenders, I think is going to be a huge solution to assisting in the standardization of underwriting in the SFR portfolio market. So, stay tuned. That's a little bit of a plug of something that's forthcoming, but we're excited to roll out a unique product to market that I think is going to be very beneficial for lenders and investors.
Yeah, and one thing I'd add from the risk side, right? So kind of the themes that we've been hearing from Michaela on the lending side is about, standardization and consistency, right? And so, with that also on the securitization side is, I think there's been some negotiations probably of what that needs to look like for SFR versus commercial, right? And so there's been some, evolution there. And one thing that we're seeing is greater incorporation of rental data into these underwrites and these portfolio analysis, right? So many rating agencies today leverage third-party rental data and analysis when evaluating the asset pools. Yet there's still some originators that have yet to bring that same review, into their loan underwrite and today a lot of them are fully relying on, undersupplied data. However, that's changing. At Altisource, we're starting to see a positive trend of lenders beginning to leverage our rent range rental data in a very similar fashion to the way investors have been leveraging it for years to evaluate their portfolios and benchmark rental rates or forecast portfolios. That's really, we're seeing more and more adoption on the lending side and bring that into their underwrite, which, they really believe is helping them, look at the future performance of a portfolio and just a strong validation of any, data that's being supplied. Another thing is just on the renovation side. I think that's really the fix and flip market. We haven't really spent a lot of time talking about that, but in today's environment, it's pretty unique as far as the risks and the challenges for lenders that are, financing those fix and flip transactions. In the early days of the industry, following the financial crash, I think, properties were largely being purchased anywhere from 70, 60, 50 cents on the dollar. Well, that's a significant cushion, if you're costing out a renovation project and something was off, right? So not as much risk there for the lenders. Fast forward to today's environment where properties are being purchased at, 100 cents on the dollar, maybe even more than that in some of the markets, right? There's significant risk there if lenders are off or their underwriting is off on the project to cost out the rental project. So there's significant financial risk there. We've seen lenders, really be diligent about decreasing that risk and profitability, by ensuring that the pre-close costing review is consistently performed with a rigor and analysis using local construction data costs. I mean, that's been a big thing. Our Granite construction risk management company, we've really spent a lot of times with those, participating in the fix and flip space to really hone in on their credit policies and how they're, looking at these projects. So I think that's something that I think still as an industry can continue to be more standardized as far as underwriting those rental loans. But it's been really interesting to see just the risk, how it increases, when home prices are high, you really need to be spot on with those rental projections and costing it early and correctly to local markets.
Yeah, I couldn't agree more. I mean, hence the scaling back to 70% LTV while things were shaking out, right? I think since then we've gotten a little bit more comfortable, but just to add, right, for us, reducing credit risk, like so important just to have high quality, credible vendors in the space. We've worked with a lot of folks since the inception of the program. So we rely a lot on our vendors, making sure you can run, strong credit and background checks. We're spending a lot of time vetting folks with a lot of different services. Mitigating transaction risk is huge right now. Just laser focused on fraud and wires, not just on borrowers in terms of fraud, but bad actors, hackers, potential, title issues. So we're spending a lot of time trying to make sure that we are protecting ourselves against, just possible bad actors.
Interesting. Thank you. Ben, let me turn to you. I got about 11 minutes to the top of the hour, but I wanted to come back to you with this one last item we had on our agenda, and that's about paths forward to increase access to capital for real estate investors. Could you chat with us for a few minutes about that before we go to audience questions?
Yeah, absolutely. I think, kind of two looks at this, right? One is for those investors that are really looking to leverage debt to grow their assets or grow their portfolios. As Michaela alluded to earlier, right, securitization activity and confidence, I think, will be the key to unlocking greater access to debt and lower interest rates. I would expect that rating agencies will take an even more active role in the marketplace and work with originators and due diligence providers for, tighter alignment on rating parameters. Ensuring that those flow down, right, to the original loan underwrite. I think that's really critically important. I think some originators have already been doing that, taking a proactive approach and aligning with the rating agencies. But I think you're just going to see a better intersection there in the years to come to really improve that securitization. On the due diligence side of securitizations, I think that blockchain adoption is inevitable. I really see that we're going to see a lot of movement there in the next 12 to 24 months. On the securitization side, there's just tremendous benefits when you look at blockchain and what it can do for this part of the market. On the other side of that is for those investors looking at equity capital as their avenue for growth. I think similar to portfolio underwrites, they should be performed similar portfolio underwrites should be performed and showcased, when seeking investments. Large hedge funds and global investment firms are coming into the SFR market pretty strong right now. With significant capital to deploy. So it's going to take more than a favorable balance sheet to raise that additional capital. Equity partners are going to want to see how well you know the markets that you're operating in, what's the historic performance, how are you using data to influence portfolio decisions, and how well are you managing, rental rates and occupancy relative to the market. So I think there's a level of sophistication that, one, COVID has helped accelerate, the infusion of capital and bringing outside capital in. We're just seeing some radical growth and sophistication within the market right now. So it's really exciting to see. It's really good for the market. A lot more competition than I think we've seen in recent years. But that really helps, move the market forward. So really, really great things to see. And I think securitizations are certainly going to see a lot of activity in the coming years.
Excellent. Anyone have anything to add to that, or if not, I'm gonna jump into questions from the audience.
Sounds good.
Okay, good. All right. Well, as promised, everyone, we've got some time here for some questions, and if you have something on your mind, now would definitely be the moment to get that question in the queue. But I see some good ones here already, so let's just jump right in. Okay. First question, and I'm just going to toss this out to the three panelists. While reserves inched up during COVID, are the initial liquidity formulas for sponsors, have they also increased?
I can take this one. The answer to that is no. They have not. We're still at a 25% of the loan amount for net worth, 5% liquidity. So thankfully, that has not been something that we've increased.
Excellent. All right, good. All right, next question. With respect to Ben's comment early in the discussion about aggregating distressed properties versus aggregation through BFR, I am not seeing the distressed opportunity reveal itself. Does the panel think that distressed SFR will really represent a large portion of properties purchased going forward? Yeah,
I mean, so to answer that, you probably haven't seen it reveal itself because it really hasn't happened yet, right? The moratoriums are still keeping that foreclosure pool at bay. So I think, what we're seeing is a lot of investors preparing for what's to come in 2021. The amount of severely delinquent loans, if you look at like the FHA portfolio specifically, I think it's north of 11%. I don't recall the specific stat, but that was about 3 weeks ago that I looked at it. So there's substantial opportunity that's going to be coming in 2021 for foreclosed or distressed assets. So I think we're just seeing a lot of investors position for that. But yet you're right, it has not revealed itself yet. It's really more about, indications that is coming, and it might come in a wave. The timing is, I think, what everybody's trying to anticipate. When you think about some of the forbearance protections that exist after the moratoriums are lifted, what's that timeline look like? Is it 120 days? Is it 180 days? Are there pools of loans that will actually just be, released in a wave through the foreclosure process that maybe weren't as restricted by the moratoriums, but the lenders were just holding them, or servicers were holding them out of an abundance of caution. So there's a lot to be seen, I think, in 2021, and we're seeing a lot of attention and strategies from investors to make certain that they optimize on that opportunity.
Ben, I'm curious if you could comment a little based on what you're seeing, because it's such an interesting world right now, especially from a recessionary point of view, because you've really got, sort of a divided sort of economy with 65% doing fairly well and the lower 35% not doing so well. Unlike the last recession where, it didn't matter if it was $1 million homes or $30,000 homes, everybody was upside down. Where from these foreclosures and when the moratoriums, get lifted, where do you see from kind of a class of the assets from, A-class homes to D-class homes, what's going to be coming down the pipe in those foreclosure markets in your mind?
Yeah. So, I mean, just from what we've been able to glean from some of the data, I think you're looking at the lower end of that. You're looking at C and D is probably where the bulk of that's going to come from, Michael. It's possible you'll see sprinkling of luxury homes, but that's less likely, I think, in this round.
Yeah, that was my take, but I was curious what your thoughts were. Appreciate that.
Excellent. And we're really close to the top of the hour here now, so I think that is a very good note to end on. We always try to bring our knowing that so many folks are rushing off to something else right at the top of the hour. So we will give you a moment or two to gather your papers and turn to the get ready for your next appointment here.
Hey, Mike, real quick, there's one question that came through, and I just wanted to answer it quickly because it ties into what we just discussed. Yeah, one of the questions was distress inventory discussion, right? Is that an expectation in rentals or delinquencies on primary residences? And what we're seeing today, most of the delinquencies are on the latter there, the primary residences. That's where we're really seeing an anticipated spike in foreclosures. Again, the rental market has performed, phenomenally well through COVID. Will there be some delinquencies? Sure, absolutely. But, not like we're anticipating for the wave of, primary residents that's where really the foreclosures are anticipated.
That's a really good point and good question because, again, it gets back to the strength of the SFR market. So if you're the type of investor that does like to buy C and D class, properties, if those are the people that are going to be losing their homes, the likelihood of them going into a C class 2-bedroom apartment is very unlikely. They're going to look to rent a C class home. So then the operators in that space, their rental demand is going to stay strong. Because the rental demand will go up, which is the beauty of the SFR market.
I love it. We got that last question in. And of course, just as we get to the top of the hour, I see a whole bunch of questions coming in from the audience, which I'm afraid we're not going to be able to have a chance to get to. But But as I said, we'll definitely follow up after the program. So thank you so much for asking these questions and participating today. A big thank you to Michaela and Michael and Ben, all of you thank you for being here. It's been a great hour of discussion. And everyone in the audience, again, couldn't be happier that you're here with us today, participating in these poll questions, asking these questions. We will be sending you a follow-up email in the next day or two that'll have a link to a recording of this event, so you'll be able to kind of re-listen to the highlights at your leisure in the future, and we encourage you to do that. And with that, I think I will officially wrap it up. Wish everyone a wonderful rest of the day, and I hope you'll join us again here very soon. Thanks so much.